Welcome and thank you for joining our latest webinar. I'm Milosz, Papst, Director of Investment Trust Content at Edison, and today we are discussing the future of the Diverse Income Trust. I'm delighted to welcome Gervais, who's one of the managers of the trust. Just before we start, I just wanted to highlight that there will be a Q&A session at the end of the webinar, and I strongly encourage our audience to submit questions. Gervais, the floor is yours.
Thank you very much, and thank you very much for listening into this. As you know, the Diverse Income Trust is proposing a merger with the Multi-Cap Income Fund, both managed by myself and Martin. The strategies are near identical. The portfolios aren't quite identical because when we buy and sell shares for a cash inflow or cash outflow for the Multi-Cap Income Fund, then we don't do all the shares. There is some slight differences, but overall the portfolios are very similar. The strategies are similar. The long-term returns are very similar. So what we really wanted to talk about today wasn't so much the diverse income position, where we can talk about the portfolio, but most particularly how, once it's merged with the Multi-Cap Income Fund, how the strategy will go forward and our views on the future. So we've entitled the presentation after the outperformance of Mag 7, why we believe a fund like this, not just Divi, Multi-Cap Income, has strong return potential, and that's not just long-term, that's over short terms as well. For those who don't know us, if we move to the next slide, the interesting thing about the way that we manage funds here at Premier Miton isn't so much that we have a range of funds like many other fund managers, but we allow our fund managers a little bit a wider range of opportunities. In the case of the Multi-Cap Income Fund, it's not just a company which invests in large companies and mid-sized companies. There's many smaller quoted companies. That includes many AIM-listed companies. We don't invest in unquoted companies. So the nature of the portfolio is probably more wide-ranging. It's more wide-ranging in the case that it's invested in things like mining stocks and energy stocks and some capital-intensive financials, as well as others which are in the more mainstream income sectors, which people would expect in some of the financial, some of the life insurance companies, that kind of thing. If we move to the next slide, I think it's worth starting really with where a lot of investors are. We're in a period of uncertainty. In a period of uncertainty, there's a lot of things which people tend to kind of assume about the future, and one of them is that prices may have been distorted, but markets are reasonably liquid. Surely if there's any distorted asymmetric risks, they can be unwound over time. There's no urgency to do anything. The UK market has had a catch-up in the last sort of year and a half, but actually a lot of people say, well, it was a bit cheap and probably won't run much further, and so it's nice to see it recover, but don't expect much from it. Others might say that the whole point about ETFs is that they are very strong and they produce some great returns, and actually, what's the point of small caps? Why include small caps, really? They're a minor part of the market, they're generally liquid. Some of the active funds charge a little bit more than the ETF. So is there any point in having small caps? And then other people just say, well, the uncertainty is high at the moment. Just go back to index funds. Why take active risk at all? We think all of those statements will be challenged. We think the market's changing as we move from globalization to nationalism, and specifically, we believe that this strategy, the opportunity to invest in UK quoted companies generating good and growing income, a fund which doesn't just obviously hopefully achieve good income growth over the long term, but also which has the opportunity when they succeed for some of our companies not just to survive, but actually thrive in a period of uncertainty, and actually where share prices, because they're less mature and lesser valuations when we invest them, for them to greatly outperform as they move up the market cap range. So with the next slide, I thought we'd just start really with what's been happening in the last sort of 5 and 10 years. What tends to happen is that a lot of investors sort of feel uncomfortable with some of the existing holdings when they underperform. This is kind of perfectly normal, and so people get a bit bored. They don't want to buy more, and quite quickly they decide to sell some, particularly if you're expecting a momentum trade where the momentum's negative. And the net effect is actually that the peaks are higher, but it can be the share prices can be lower. And particularly in the last 5 years, when we've seen this huge surge of uncertainty about the UK stock market and whether the US is going to carry on outperforming, we've seen a lot of redemptions across the UK OIC sector. And that has meant that actually UK share prices have been depressed. Large companies have held on pretty well. They've bought back quite a lot of shares. Small companies haven't bought back so many shares because they're investing for the future. So we've got a lot of distorted share prices around at the moment. I think that the popular shares, some of the US technology stocks and some of the mega caps around the world are on relatively high valuations, but we would argue the UK, and particularly many of the small companies in the UK, are not just on low valuations but abnormally low valuations, and we think there's a great chance therefore for these distortions to be unwound over forward. It's a bit like when you go to a place where you've got two speakers and you get very loud points in the room and very soft points. There's very loud points in the market where valuations are very high, but there are other places where the market's very soft, where the recovery, the upside potential is so much greater. So when you look at this fund over the last 5 years, what you can see really is that in the next slide, the long-term performance has been excellent, but it's been less obviously excellent in the last 5 years. There was a period when it didn't make much money, 2021, 2022, 2022, 23, and even 23 into 24. But what's been interesting about that was, despite the fact that a lot of share prices didn't go up, the underlying income has been excellent. So this wasn't really an effect down to disappointing companies or disappointing trading or dividend cuts. Of course, there will be some in the portfolio which didn't do well, but most of the portfolio was doing perfectly well. The growth in the income was coming through perfectly happily, and actually the share prices were being distorted by this overhanging UK OIC redemptions. What's been interesting over the last couple of years is actually the UK market hasn't just done okay in terms of share price appreciation. It was up something like 36% last year in total return terms, but I'm talking about FTSE 100. But what was interesting is actually in dollar terms it was even stronger. It was quite a good year, one of the best performing markets globally. And although small companies haven't improved in the UK as much as the big companies yet, we are now seeing not just the opportunity for some of the share prices start to appreciate, and we've had a good couple of years, but also on top of that we're also seeing the added value coming through in the portfolio, and therefore the fund over the last 5 years, and indeed since issue, has been a strong performer. If you look at the next slide now, one of the features really has been the rapid growth of indexation. These are passive funds, exchange-traded funds, which have grown enormously over the last 15 and 20 years, but most particularly over the last 5 years. And that, if anything, because when you buy an index fund, you tend to put the largest weighting in the largest holdings, has actually tended to exaggerate the outperformance of mega caps. And as companies are redeemed, other strategies are redeemed to put money into these large funds, then often many of the small companies have been sold, and that's really this distortion, the source of the distortion that we've been seeing. And ETFs will be an important part of the market going forward, but they only really work when the markets are rising. They're what's called beta. They've got the volatility, the long-term return of the market. They don't add value. And you can have long periods when actually markets stagnate. They don't just go up, they can go horizontal. We saw in 1989 that Japanese market had many years of very strong returns. And unfortunately after 1989 the market stagnated, and if you held an ETF in Japan over the last 25, 30 years or whatever, you wouldn't have made a very good return. So ETFs do have a position in portfolios, but ultimately we believe that there are other strategies needed as well. So if you move on to the next slide, I mean, what's interesting really is we've seen these kinds of very theme-driven markets before. It's not always the same, but one of the examples of the past was the TMT bubble, which we saw up to 2000. And what was interesting about that wasn't just that Vodafone was one of the most exciting stocks in terms of investment at the time, the 3G licenses, but also the momentum and excitement about the outlook for Vodafone meant that its market capitalization rose from 7 billion. It demerged from Racal, if you remember, back in the 90s. But more importantly, with the momentum of that share price and with the excitement about the 3G licenses and the growth of the 3G licenses and 4G and 5G, which has obviously come through subsequently, is that the valuation of that company rose very, very sharply. And at one point, its market capitalization was over 240 million. And you can see how the share price rose. But you can also see, unfortunately, that when assumptions about the future changed and growth in 3G returns wasn't as strong as people thought, that when you get a share price which has risen substantially, you can find that the momentum on the other side, the negative momentum, can be equally as strong as the momentum before. And you can see here how the Vodafone share price rose dramatically and fell dramatically in 2000. And what was interesting about that was not just the scale of the losses, up to 80%, but most particularly this speed of those losses. So just sitting still in some of these companies, being a long-term investor, can lead to very sharp share price moves. But more important than that, we now have the advantage for the last 25 years. And what's interesting about the last 25 years, the subsequent 25 years from the dot-com boom, is that actually despite markets being fine, global economy being fine, actually in this case, Vodafone, the share price still hasn't gone up over the following 25 years. So what we're really saying is that some of these very stocks with a lot of expectation in can sometimes not perform, but they can lead to share price disappointment in a major way. So if we go into the next slide, what's interesting from our point of view is that when we meet companies, Martin and I, we tend to meet companies across the full range of size bands, but we also quite like companies which often have a strong financial backing, not just in balance sheets, but also many of the companies have a lot of assets. We're not just talking about mining and perhaps some of the energy companies. Some of the financials will have a very significant amount of capital. Some of the defence companies, some of the property companies, that kind of thing. Some of the utility companies. And actually the whole point about that is, one, that actually these things take a long time to build. And so as the cost of capital goes up, people are less likely to build competing assets. But most importantly, when things go well, they can go very well. So the nature of it is that the pattern of returns can be that you get a fairly long period where perhaps the returns aren't that exciting, but then when things come right, they come very, very right. And if we look at where the market's moving on the next page, we think that there will be a move beyond Magnificent Seven. We think with nationalism coming through, with uncertainty about tariffs, with uncertainty about export bans, with in nationalism there is more military conflict, unfortunately, that many of the patterns which we got used to during the globalization period, assets which benefited from this kind of distorted market excitement about share price appreciation, what we call reflective trend, will move across to companies which are much less correlated. So high beta companies, these are very highly volatile companies which tend to go up even faster than the market when the market's rising. We think that they need to be mixed going forward in institutional portfolios with other income shares which are low beta. They're less volatile than markets, and they produce a lot of return, not by capital appreciation, but by the stream of income they produce. And the sectors will also be widening. So whilst technology and a lot of software companies did very well during the globalization phase, we think that capital-intensive sectors, things like materials and financials, will be particularly well placed. We think during the period of the last 30 years, with debt being relatively benign, inflation being relatively benign, debt being relatively plentiful, every time there was a downturn, there was extra financial stimulus. Very few companies went bust. A lot of the zombies are still alive. We're taking the view that actually, with the more specifics, uncertainties regarding tariffs and export bans, and of course the lack of supply, perhaps because of the Straits of Hormuz, that stock-specific risks, you're going to be needing to diversify by a more widely ranging portfolio. You don't want too many concentrated portfolio holdings. In the past, generally, buy and hold worked very well. If you'd held Nvidia for the last 10 years or whatever, you didn't need to buy and sell it. You could have just held it. But if you get geopolitical events, of course, we argue that you'll be wanting to take your profits on many of your holdings, so that if there's a geopolitical event and share prices suffer, then you've taken a part of your profit. So again, there'll be a more, you'll be needing to kind of keep your portfolio weightings moderated through the cycle. And the last point is, really globalization was all about bigness. We would argue that nationalism is all about localness and smallness. And again, we think that globalization very much favoured the US market. The US market, about 3/4 of the entire world markets are listed in the US now. And we think that other markets, UK markets specifically, are not just set to outperform. But as you take capital out of the big companies in the US and put it into other markets, what you may find is actually you get this amplification effect, and share prices move rather more than people think. And to sort of underline that theme on the next slide, what's interesting from the point of view of perhaps some of the capital-intensive sectors, we've taken gold mining here, was that actually, for the last 25 years, up to 2024, we've just taken two random gold mining companies which have been listed in the US for over 26 years, was actually, they had some good years and some bad years, but in general, there wasn't that much excitement. Inflation was benign, as I say, for most of this period. But actually interesting on average, annualized return, including income, you would have received something like a 3% total return on an annualized basis from Newmont, around 1% from Barrick. But what we saw in 2022 with the invasion of Ukraine was that Russian central bank was suddenly found that it wasn't able to take control. After the invasion, it wasn't able to have its access to its US bonds or European bonds or whatever. And as they did so, you found actually that caused other central banks to start wondering about their own bonds, whether they should have quite so much in US bonds or European bonds. And so in 2023 and 2024, a lot of central banks reviewed it and decided to buy some gold as a diversifier. And during 25, with so many central banks buying it and some investors buying it as well, gold prices, rose from about sort of 1,700 2.5 years ago, 3 years ago now, to 5,500. And gold mining companies, which take an awfully long time to build, were unable to produce much extra gold. And so that's why the share prices rose. They became extraordinarily profitable. In this case, Newmont rose 170% during 2025. Barrick was up 186. Many of the smaller gold mining companies rose even more than this, 3, 4, 5 times. And that's the nature, really, of capital-intensive businesses. If you're in a capital-intensive sector, which takes a long time to build an asset, then when you do find that demand is sustained or rises, you don't just get a return, you get a disproportionate return. So when you look at the last the current position of the London market on the next slide, what is interesting about it is how many of the companies in London are dominated by capital-intensive sectors. Yes, energy. Yes, many of the utilities and mining and banking and all of these. And so they produce good and growing income. And so if we are looking at a pattern change with people moving away from a very overweight position in capital growth stocks into a move back into capital intensive income and income growing stocks, then we think this is going to be a feature which favours the UK market. And that certainly has been the case over the last say year and a half, when the UK has greatly outperformed US markets, including the Mag 7. So if you look now, and the next slide, the other features, although share prices have been depressed during the last 5 years with redemptions, what's been interesting is that many companies, particularly UK quoted companies, among others, have used some of their cash to buy back shares. And this is showing how much the share prices of companies which have bought back their shares have been enhanced. Many of the smaller quoted companies are busy investing for the future. They don't have cash to pay back. So you can see that the valuation difference between maybe some of the larger companies and some of the smaller companies has really opened up. And that gives us an opportunity to pick out good and growing income shares, not just in the mainstream market, but all in the smaller end of the market, the AIM market as such like. Now, of course, things might get worse. We don't know how the Straits of Hormuz is going to unwind, but there probably will be an economic slowdown. If you've been spending extra money on petrol, you can't go to the pub so much. So the net effect is that actually we think that it's going to be a more unsettled world. We think many of the companies with a lot of debt may become insolvent, perhaps some of the very highly leveraged private companies. So what's interesting about quoted companies, particularly quoted companies generating surplus cash, is one, that they are less likely to go bust. But on the next page, what's also interesting from our point of view is you actually see them starting to take advantage of the weakness of others. They can move and expand into the vacated markets. So if we move to the next slide, effectively what you see here, if you make an acquisition from a distressed seller, maybe an insolvent business, where you buy a business from, which is a viable business from a part of an insolvent company from the receiver. If you're a big company, because 300 million doesn't have a big uplift when you're already a company which is already, 5 billion or 10 billion, you can see the difference in scale, and I showed an logarithmic scale, in a large cap doesn't make much difference. As you move down the market cap range to sort of 500 million pound company, moving from 500 to 800 makes a more significant difference. There is definitely an opportunity for an accelerating of earnings there. And as you move into a micro cap, from 100 to 130 million or something like that, you get proportionally much larger. From 100 million to 300 million, you get a proportionately much more significant growth and some transformational upsides. So our working assumption isn't just that UK is cheap. It's not just that it's relatively safe. It's not just got companies which may benefit from conflict and export bans, but most particularly, if things get really tough, then actually there's opportunities for UK quoted companies not just to continue to do better than most others, but to accelerate growth. And certainly back in the 60s and 70s and early 80s, with the uncertainty and the companies going bust and all the rest of it, many of the UK quoted companies outperformed not just other global markets, but most particularly the US market. The UK was one of the best performing stock markets in the world, and we think that could happen again. It started to happen in the last 12, 14, 15 months. So going forward, an example of that is on the next slide, where you've got a company called K3 Capital. This is taking us through the period of COVID 2020. This was a company which was heavily involved in buying and selling companies. It was a tiny, it did very tiny acquisitions on a fixed price for people who didn't need to go to the merchant banks and stuff. But what was interesting is the company came to market back in 2017. It did extremely well. It was growing extremely well. Of course, during the 2020 period, there was less buying and selling of companies. It still had a very strong balance sheet. It paid its dividend. Its earnings were much lower. But they came to us and they said we could buy some acquisitions, not from insolvency, but from very panicky sellers who are happy to sell their businesses at what they considered to be an abnormally low price. And if we bought these businesses, we believe that we could generate a transformational, and the word was transformational upgrade. To fund those acquisitions, they raised new capital. We supported the issue at £1.50. But what was interesting is the company went on within 3 years to pay a dividend yield exceeding 10% on those new shares. And so from that point of view, the risk-reward ratio in having a company at the smaller end of the market cap range able to not just survive but thrive during a period of uncertainty. And so if you go on to the next slide, that's really the long-term pattern. Yes, big companies can make great returns. Mega caps have done extremely well. Some of the Magnificent Seven, particularly over the last 10 years, have done extraordinarily well. But that's not the long-term pattern. When you look through, all the different economic conditions, the recessions and the nationalism and the globalization, you can see that whilst the mainstream companies make good returns, this is the Deutsche, large cap index, which is that sort of slightly sort of bluish colour. You can make, over since 1955, they're up 1,255 times. But as you move down the market cap range, the returns get better, and not just the mid caps, but so that light blue colour, that's the small companies index. And then as you move into the micro caps in the pinky colour, you don't just get 1,255 times your money, you get 21,168 over this particular period. So what's interesting about that is that as you get a passive tailwind. Now, we haven't had that in the last 5 or 10 years, but we think that with valuations being low, we think with the uncertainty coming through, with the opportunity for upgrades from acquisitions from distressed sellers, we think this pattern will be repeated. And so if you look back over the last 5 years on the next slide, specifically, there are quite a lot of portfolio holdings. Even when small companies have been under real pressure, we've had a headwind rather than a tailwind. We've still had a number of holdings which have risen. Some of them have risen very dramatically. You can see some of these have moved up 3, 4, 5 times. Pan-African Resources has risen a lot more than that. And so coming back to that, we're in a period where without the tailwinds, a lot of small companies have succeeded. Going forward, we think that actually with headwinds dropping away, with tailwinds coming through, the upside potential on this strategy could be more exciting than it has been even over the last 5 and 15 years since we set the fund up. So interesting, when you look at the portfolio on the next slide, in the characteristics of it, this is since this fund was set up back in 2011, is that actually, in contrast to most other equity income funds, it has a beta. That's the reflection of how much it moves up and down with the market. So if the market moves up, say, 10%, with a beta of 0.7, this fund would move up 7% or go down 7% on average. But what's interesting about a fund like that, often a fund like that doesn't have the ability to make great returns. But because we invest across a wider investment universe, because we pick out stocks in the AIM market, mainstream market, because many of these companies don't just survive, but they thrive because they start to expand into markets which have been vacated and such like. The alpha, the ability of an extra return, up 4.7 implies that on average the fund generates 4.7% more return than the market on average. So it's very, very unusual to have a fund which has the lowest beta and the highest alpha simultaneously. And as you see, that comes through in other factors: drawdown, Sharpe ratio, short-in ratio, and volatility. So that's the pattern. That's the fund that we're proposing as the merger partner. Clearly, small companies have been under real pressure over the last 5 years. So some people might say, well, that's very well, but what do these figures look like over the last 5 years? And on the following slide, we show you. And what's interesting about this is, of course, you wouldn't expect the beta, the volatility of the fund, the mix of the fund isn't going to change very much, so it's still very low. But what's been interesting is that many of the smaller companies, when they've been succeeding, their share prices haven't been going up, and in some cases, with the excess sellers, their share prices have been going down. So the fund apparently has an alpha which is normal, subnormal. We're not adding value. But that's really comparing with a portfolio which has 80 or 90% in the large caps. This fund has some large cap portfolio holdings. It has about 40% in the FTSE 350 companies, but that means that it has 55 or 60% in other companies, yes, small quoted companies, AIM listed companies, etc. And when you compare the valuations and the performance of, say, the companies between 0 and 200 million and the portfolio invested in 0 to 200 million, you find that there's considerable added value. And when you look at the 200 to 500s and the £1 billion companies and the £5 billion companies, you find there's added value. So actually, if you look more at apples rather than apples and oranges, which is what this mix gives, you find that the alpha has been very strong in the last 5 years, just as it has been prior to the last 5 years. It's just that prior to the last, effectively we're comparing it with a portfolio which is principally invested in large companies, and small companies have heavily underperformed during this period. So when you look at the portfolio on the next slide, what's interesting about it, and actually you've jumped on, I think that's the one, is that you've got many companies which are well known to many investors, Aviva, BT, these are companies which are big, large, mainstream companies. But they also spread amongst them are lots of companies which people don't know so well, and so effectively we have got a range of different sectors and a range of different companies invested in real estate, in defence, in financial things. Galliford Try, we talked about it in the past, which is a construction business which is taking on an awful lot of extra low-risk projects. So the net effect is that many of the holdings are 1 or 1.5%. They're quite small. As they get bigger, we've taken profits on some of these holdings and recycle the capital. And that's another way to add to dividend growth. If you sell a company which has risen, the share price has risen faster than the yield, then you'll find that the dividend yield, then you do find that you get, as you move it back into companies with higher yields, that gives extra dividend growth for shareholders. So going forward, we think that actually, if you look at the next slide, the UK is outperforming at the moment. We don't think that's just a catch-up trade. We think that this is a longer-term trade related to the nationalism of the global economies, nationalist sort of politics opposed to globalization politics, and that's leading to new opportunities and shortfalls in certain areas. So one of the holdings in the portfolio which we've invested in this year is a company called Tungsten West, that you may know. It's a Devon mine. It's a tungsten. They've raised 45 million early in this year, and what you can see is the share price has risen very substantially. As it comes into production later this year and into next year, effectively this company will be one of the lowest cost tungsten mines in the world. Tungsten price is very high at the moment, so they make lots of profit. But more importantly, it'll be one of the biggest tungsten mines in the world as well. And so, these are the kinds of opportunities. Yes, it's not producing income today, but we think over the next 12 months it produce plenty of income and plenty of return. And that's the nature of the valuations of many income stocks in the UK are very undervalued. And the pattern's changing as well. If you look at the next slide on page 23, this is showing the correlation between different assets. The top bar shows the correlation between equities and bonds, share prices and bond prices. And during what happened during the globalization period, with debt being being plentiful, but most particularly inflation being benign, every time there was an economic downturn, generally governments and central banks could inject extra stimulus, boost the valuation of bonds, and in doing so boost the availability of debt, and that meant very few companies failed. But what you saw as markets went down is that valuation of bonds went up, and specifically when that cash got into the markets recovered, maybe bonds, people took some profits on bonds, and so it was very successful for many investors to invest in bonds and equities because they moved in an uncorrelated fashion. What was interesting really about the period prior to globalization, back in the 90s, or indeed more recently when we've seen nationalism is that actually, unfortunately, when we see the downturn as we saw in 23, or perhaps this year, early this year, don't just see share prices going down, but you see, with worries about inflation, bond prices going down in a correlated fashion. So bonds and equities are not diversifying in the way they would. Really, you need to buy physical assets, this is mining companies and commodities of different kinds, oil and things. And so what's interesting about that is we believe there'll be a pattern change and people will invest in more of these capital intensive assets. Again, it's another reason why we think the UK stock market's going to outperform. In terms of the two funds, page 24, what's interesting is in the past the Diverse Income Trust has held a put option. We don't have one in place at the moment. But what is interesting is the multi-cap income fund does have a put option. We believe that it's a good time to have a put option. What's it there for? It's there for the extreme rainy day. Most years there isn't an extreme rainy day. It's a bit like buying car insurance. If you buy car insurance and you don't have a crash that year, you don't get your car insurance back. So it is a net cost. It is a net cost on average of 0.8%, maybe up to 1% sometimes. But most particularly, it's there for when there is a big correlated market setback. And we're not saying there's one, we're not forecasting one, but if there was one, as there was in 2008 or indeed 2020, then having a portfolio with a put option in it, like this FTSE put option, it's about 20% of the money. It covers actually quite a big part of the portfolio, about 3/4 of the portfolio, because actually it's relatively cheap. It extends through to June 2027. So if there was a stock market crash, say in June of this year, you would have a whole year of time value, plus obviously the stock market might well go below 8,200 as it did in 2020. And therefore you don't just get something which goes up in value, but you can find something which makes a multiple of your original investment. Back in 2020, I think the put option, which is only covering about half the portfolio in that time, added about 8%, or certainly we were able to take 8% cash out of the selling of the put option, which then allowed us to buy more equity income stocks and grow the income line. And the fund itself has a stronger income than most others. I mean, if you look at the income across the London market, Computershare Dividend Monitor, for example, shows that dividends rose up to 2019, came back in 2020, and then have leveled off at about 2016 levels. In other words, they haven't gone back to 2020. And if you look at the income of this fund, or indeed the multi-cap income fund, then the income came down in 2020, the revenue per share fell in DB. They paid a slightly raised dividend despite that, but and the revenue per share has grown beautifully over the last 5 years, and indeed as income has grown in the multi-cap income fund. And so the fund, the Diverse Income Trust actually has a slightly higher yield. It doesn't have it doesn't charge any expenses against its income, so the yield is slightly higher. So if you do accept the offer to move into the multi-cap income fund, you don't just get a good and growing income stream, but actually a slightly better yield than you're getting with the investment trust. So valuations are extraordinarily low in our view. This is one way of measuring valuations, price to book. You can see here that the UK stock market has moved in valuations a little bit. It was only about 1.5 and it's now about 2.2, 2.3. That's the mainstream market. As you move down the market cap range with the underperformance of small companies, many of the smaller micro cap companies are standing on a price to book of 1.5. When you compare that with the US, that's about 5.6. In other words, US valuations about 3 times as much as our small companies in the UK. If you look at perhaps the Magnificent Seven, which are very high expectation share prices and they've performed very well in the past, then they're about 10.6, which is about 10 times the valuation of our small companies. So there's a really great catch-up trade. If we get more growth because of uncertainty, if we invest in companies from the receiver and accelerate the income growth, then ultimately we think the total return in the UK market will be much stronger than the main market. And you can see the fund itself is standing on what we consider to be an extraordinarily attractive valuation. So conclude on the next page. I mean, globalization has been really about a long-term pattern. We've seen share prices move to extreme overvaluation relative to norms and extreme undervaluation versus norms. We think the UK and particularly small companies are in the undervalued category. And we're seeing this change in behaviour. And what we saw with Vodafone and other things is when the change comes, it can come quite fast. And we think that capital can quickly move into floods of liquidity. That will clearly move into the UK market, but we think it particularly move into the small companies. US small companies are starting to outperform. UK companies haven't quite started that, but it can't be long. Small amounts of money can make a massive difference at the more smaller in the market because there's less liquidity. And specifically, we think equity income stocks, they're not just positioned because they're safer, but we think that actually investors who are overweight in what was called high beta shares are going to buy low beta shares, and that mix change is going to drive extraordinary catch-up in trade, in performance. And as those valuations move up, PLCs can actually acquire assets at lower and lower valuations, so higher and higher issue share prices, and lower and lower cost of equity. And specifically, we think this fund is superbly well placed for that. We're very excited about the future. We think this strategy is very well placed. We'd be very happy to take any of your questions. Thank you very much for listening to this.
Thank you, Gervais, for the very insightful presentation. We'll now begin the question and answer session. Anyone who wishes to ask a question can do so by using the chat function on our platform. Maybe we can start with just discussing the most recent macroeconomic events, including the US-Iran war. Has this in any way dented your optimism or enthusiasm for the UK equities and small caps in particular?
Well, the answer is no. What's interesting is the portfolio hasn't changed very much with the Iranian war. I mean, we had relatively light weightings in consumer stocks and many of the more vulnerable sectors. That wasn't because we knew that the Iranian war was coming, it's just that we just got a resilient portfolio. So there's been very little change to the portfolio from that point of view. So first of all, the fund has held up well. In fact, it's performed fairly strongly year to date. It's one of the best performing. The multi-cap income fund, I think, and obviously I was just checking this morning, but it may be wrong tomorrow, but it's the best performing of all the income funds, the UK income funds year to date. And what's quite interesting about that is that's without even small companies having moved. They've been lagging the mainstream market. So it's outperforming many of the mainstream equity income funds, which have much larger weightings than the mainstream funds. So that's nice. So but coming back to our assumptions, we don't know what's going to happen about the future. The range of outcomes is extraordinarily wide. It could be that Trump manages to do a great negotiation with Iran, and maybe they do give up their nuclear weapons, and maybe Iran comes back into the fold and becomes a large oil exporter in the future. And obviously, with oil prices coming down, there may be extra growth in the world. It could be that things go on for ages in the Straits of Hormuz, and they never quite get back to normal, and there's a real shortage of petrochemicals and lots of profit warnings. We don't know. What we do know is that the winning companies, hopefully, if there is a setback, won't just survive but actually thrive as they move into the vacated markets by the insolvent. As they buy the insolvent companies, the viable parts of insolvent companies, they can accelerate growth. So we think that actually there's a big catch-up trade anyway, and if things get worse, we think the outperformance of the UK market will be even more significant than it is at the moment, and most particularly small companies will probably be the best performing part of the UK small cap sector.
Perfect, thank you. The next question would be on M&A. Maybe what have you seen in terms of M&A activity across the broader market and your portfolio specifically? Have you seen any bids recently, and also would you expect any signs of life in the IPO market?
Yeah, I mean, a lot of the UK companies are very inexpensive. They're lowly valued. There has been some big activity in the UK market. When we do meet our companies, I mean, we're hoping to make substantial returns over the 3 and 5 years. And our view is if we get 50% up in the short term, that's short-changing our investors long term. So we ask all of our companies, if they see someone trying to bid for them, they should turn them away politely, but more importantly, not tell anyone. Once you start telling people, at that stage, it's all a question of, well, what's the right price? If it's not 50%, perhaps it's 60% or 70% will do it. So we've seen very few bids in our portfolio. That's very good news. We don't want to give away all those upsides. If somebody's only bidding for the company, they can see the upside as well. And we want that for our investors. So there is some increased bid activity. It's not affected our portfolio very much. And we're jolly glad, because actually we think there's more upside by holding these companies longer term anyway.
Perfect, thank you. And then maybe you can also shed some light on the AI adoption across small caps. Of course, it's a very difficult question to answer given the wide variety of business models within small caps in general, but maybe you can give us some pointers.
I mean, the interesting thing about AI, I mean, it can change a lot of companies, specifically service-based businesses where you've got staff who are bringing data together and things. AI can do that extremely well. So it's going to be shaking lots of things up. If you're a lawyer or whatever, you may find that the competition is a lot more difficult and prices come under pressure. But most particularly, it can affect all businesses. We shouldn't affect any business to be unaffected by all of this. So the great advantage about that is, in my view, is that hopefully the weak will be unable to move fast enough. They may be able to not invest enough. Maybe they haven't got the right culture to get staff to adopt very quickly. And the strong companies won't just survive, but again, I think they will outpace the weak ones. So from my point of view as an investor, I want the weak to lose and the winners to win. And I want them to win disproportionately. And if anything, I think AI makes that differential even greater than it was previously. So yes, of course, it's a conversation with all the companies we meet. Many of them, supermarkets, and think, well, is there much AI? Well, yes, there is actually. They do a huge amount on looking at their staff and looking at their customers on an anonymised basis and predicting what they're going to buy, and actually in many cases offering you offers which actually are very specific to you, and actually you think, well, that's really rather useful. Actually, I wasn't expecting to get a special offer on some of these things, but I can save some money. So actually, I think we should really expect it to carry on shaking up the world, and most particularly, we'd like to think that hopefully if we're back in the winners will win disproportionately.
Perfect, thank you. Maybe we can shift our attention to the broader investment trust sector for a moment. And well, we've obviously seen that the boards are under pressure to be proactive. And from that perspective, now, what do you think? How will the investment trust sector look like in 5 years' time from now?
Yeah. I mean, when you look at this trust, I mean, the key feature about this trust isn't just that it's generated some nice returns, it's got a good and growing income record, that it's one of the best performing in the sector. But most particularly, actually, we've always offered all investors 100% exit every year. So there's been an annual redemption. Why have we done that? Well, one of the problems with investment trusts is when the sector's out of fashion, sometimes you get some local sellers and there's not many buyers and the share price goes down. And then the share price trades at a 5, 10, 25% discount to the main market, and that we think that's unfair on the exiting shareholders. So if you give the investors the opportunity to exit every year, then that means that that's our problem. If you need to sell your holding, tell us about it. We will sell existing shares to meet your requirement. We'll make sure the long-term shareholders aren't disadvantaged, but most particularly, therefore, by clearing the overhanging sellers, it means the share price is always closely related to the market, and that's really what's happened. Okay, the interest has moved to a slight discount, but it's been a very tight discount compared with many other funds invested in some of the smaller markets out there. But most particularly, that's led to the fund getting smaller, and the problem with that is that fixed costs are spread across a lesser and lesser number of shares. The costs of managing the fund effectively rises on a per share basis. And so this trust, it's not in any way in a position of weakness. It's performed extremely strongly, but it's the right thing for the company to limit the costs to investors. And by merging with the multi-cap income fund, effectively that's what they do. They get a strategy almost identical, and specifically they get a cost base which isn't going to rise. But coming back to investment trusts, why are they around? What is the purpose of investment trusts? They appear like old vehicles. Why would people consider them? Well, I think there are long periods when markets don't go up much. You can get flat lines, as I say, in Japan since 1989. The market flatlined for about 30 or 35 years. And during those periods, you do find there are specialist sectors which continue to generate returns, but the main market doesn't. And at that stage, those specialist areas sometimes get flooded with liquidity, and the valuation and the size of those funds are wholly out of context with the area in which they're investing in, say, small companies. And when that happens, you dilute the alpha and you don't get the upside. So coming back to investment trusts, in my view, one of the key advantages of investment trusts is that they're dedicated to a certain part of the market, but most particularly when things are going extremely well and there's only a limited number of areas to invest in, then the investment trust can say, actually, we don't want any more units to be sold, and the fund can be right-sized to the investment opportunity. So actually, we don't know what's going to happen in the next 3 or 5 years. There will be a lot more other funds which close down, Saba, Ravisi, and all the rest of it. But as we find that equity income stocks outperform, perhaps as mainstream markets outperform less, or indeed valuations come down in the US, maybe profit margins come under pressure, that you could find that stock markets stabilise and flatline for a long period. Perhaps beta is zero or worthless, and many ETFs don't produce much return. Then you could find suddenly capital's crowding into some of those areas, like the multi-cap income area in the UK, and that actually there may be a good reason to set up Divvy again in 5 years' time. We don't know that's going to happen. That's all speculative at this stage, but we do think they have a purpose. We just think that right now it's the right thing for our shareholders to make sure that they don't get their costs moving up too much, and they don't get left with a very tiny fund, and that's why the board has proposed this action.
Excellent thing. Let's hope that this opportunity will arise at some stage.
I hope so as well, Milosz. Yeah.
Now, of course, you've explained that the strategy of the open-end vehicle and MDV is similar, and that, of course, the reason for the rollover is also to maintain the scale and limit the ongoing charges, basically, ratio. Are there any other differences between DV and the open-ended vehicle investors should be aware of?
The only one which I mentioned in the presentation was that currently the diverse income trust doesn't have a put option, and multi-cap does, so there's a slight difference there. But actually the rest of the portfolio is almost identical. When we buy a new holding for diverse, we want the same percentage for multi-cap income. Of course the weightings do change when you get units creations or unit redemptions, but basically the portfolios are very, very similar. So really the answer is no, not really.
Excellent. Thank you so much. We are now approaching the end of our session. So Gervais, thank you very much for the presentation and for answering the questions. And thank you to all participants who joined today's session. Thank you very much and have a good rest of the day.
Thank you very much indeed.